Farmers can use the same accounting methods as other businesses, cash, accrual, or a hybrid mix. But farming also has special methods, and the exam loves when you spot them. Your job is to match the method to how income and expenses are recognized. Cash is usually simplest. Accrual is more matching. Hybrid is allowed when it clearly reflects income. Most farmers use the cash method, and there's a big reason: the gross receipts test. For 2024, a farming business with average annual gross receipts of $30 million or less for the prior 3 tax years can generally use cash, as long as it's not a tax shelter. On the EA exam, watch for that average of 3 years language. Here's the inventory angle. Inventory rules push many businesses toward accrual because you have to track cost of goods sold. But farming is weird. Inventory requirements often don't apply to most commonly grown crops, so many farms aren't forced into accrual. Exam tip: if the fact pattern says not required to keep inventory, cash method is usually still on the table. Now the special one, the crop method. This is only for farming businesses, and it requires IRS approval. It's designed for crops that aren't harvested and sold in the same year they're planted. Instead of deducting costs as you go, you capitalize the entire cost of producing the crop, seed, young plants, and other production costs, and then deduct those costs in the year the income is realized. When the question asks, what is farm inventory? Think items held for sale, purchased for resale, or held for feed or seed. That includes harvested products like grain or tobacco, eggs in the process of hatching, and livestock purchased for resale. It also includes packaging that becomes part of what's sold, like containers and wrappers. And don't forget storage costs tied to inventory. Quick method selection instinct for the exam. If it's a typical farm under the gross receipts cap, cash is usually permitted. If the problem emphasizes inventory tracking and matching income to costs, accrual becomes more likely. If it's multi-year crops and they mention IRS approval or capitalization, that's pointing straight at the crop method. Always ask, when is income recognized and when are costs deducted? Which of the following is not an acceptable inventory method for federal tax purposes? The choices include the allocation method, LIFO, specific identification, and FIFO. Think about which ones are standard inventory cost flow assumptions and which one sounds made up. Think about it. The correct answer is the allocation method. FIFO, LIFO, and specific identification are all recognized inventory methods. Allocation method is tempting because businesses allocate costs all the time, but it's not a named, acceptable inventory method by itself for tax inventory costing. Cedar Valley Foods is a fiscal year C corporation using the accrual method. What is required for the company to deduct an expense? The options mention paying before year-end, paying before deducting, meeting the all events test plus economic performance, or receiving an invoice. Think about what accrual accounting actually requires. Think about it. The correct answer is meeting the all events test and having economic performance. Accrual deductions aren't based on writing the check, and they're not based on simply receiving an invoice. The tempting wrong answer is must receive a bill, but a bill alone doesn't control deductibility if the liability isn't fixed or economic performance hasn't happened.